right, folks. My name is Dan Havey. I'm with Solver, here to talk about CECL Clearinghouse, a new service for banks and credit unions. Today, we're here to talk about CECL Clearinghouse. And CECL Clearinghouse really quickly takes information from banks, from credit unions, brings it into BI360, a tool we'll be using today, to aggregate information at the various loan categories. They're classified by the call reports for credit unions and banks to come up with a CECL score. BI360, just to tell you what the tool is, it's going to be aggregating all the information for CECL Clearinghouse, is essentially a data warehouse, a reporting, budgeting, and dashboarding tool. The first part, the data warehouse, is key to CECL Clearinghouse. We can take data from any source, typically your asset liability model or your core data system, Excel, data warehouse. Really, any source brings in a common SQL Server data warehouse. And then we do all sorts of reporting and budgeting and analytics. The way folks are calculating loan loss reserves today, they're basically classifying loans much the way they do for the call reports. Here's how the Federal Reserve does it, and CUA does it basically the same way. They've got credit card loans, they've got leases, they've got commercial real estate, consumer loans, mortgages, and all those separate pools. And essentially what folks do is look at the historical charge-off rate for that loan type and multiply it by the expected number of years that loan typically is on the books. So if we look down at the very bottom, mortgages, we're having a 4 basis point charge-off. Annually, we're charging off 4 basis points of the mortgage portfolio. Pretty strong right now. So we expect to have those mortgages on the books around 7 years. So 4 basis points times 7 years is a reserve of 0.28%. The big deal, though, with CECL is it allows us to come up with a reserve at the individual loan level, not necessarily the pool level. So we have to get much more granular when coming up with a reserve for our loans. You have to now start coming up with data elements at the note level that are going to have some predictive value in determining what the current expected loss is going to be for that specific note. And so that involves predictive modeling. In an ideal world, if I had 100 data points for every single one of my notes, I can come up with a very good predictive model. The problem is to come up with all those data points is cost prohibitive. So what we have to do is be judicious in what data elements we're going to go after. There's many folks that have done lots of studies already on what are the best predictors, and they come up with about 7 or 8 common ones you'll see in almost every discussion. The way it works is my 2 best predictors. If I just build a model off of just those 2 alone, in theory, I'm going to come up with a model that's going to have 68% confidence. I'm going to feel pretty confident that I'm coming up with a good CECL score for that note 68% of the time. If I expand it to 4 factors, my confidence jumps to 95%. And obviously, the more factors I add, the less additive it is to my confidence level, because you have a law of diminishing returns. So what we're going to want to do is pick the 8 best factors, 4 to 8 best factors. We're going to give you the biggest bang for your buck. What we've done based on our research and collecting data from many organizations, we've expanded it from those 2 best scores to about 7 factors. It's really going to give you the biggest bang for your buck. And so CECL Clearinghouse, what we're doing is we're taking this input data from as many institutions as possible. We're going to commingle it and come up with very good predictive models. But there's going to be a method to this madness. So let's start off with the individual columns. I'll just go through what they are and then how they're going to be used in the model. Obviously, the period. What time period is this information relevant for? In this case here, it's 2016, June 30, so the month of June. Ideally, what we would like is for a bank to send us 12 good months of loan history that's got these facts, if you will. 12 good months, that's going to be enough to play in the model. Doesn't matter how big you are, how small you are, doesn't matter to us. We're adding you to a lake of data, and we're going to be modeling the information. Obviously, the loan number, to participate in CECL Clearinghouse, we do not want anything that's customer related. We don't want anyone to figure out who this is related to. But for your purposes, you're going to need to have a unique identifier, loan number, or it could be, a record number, something like that. But we're going to need a way when we're scoring these loans, you're going to need to be able to pair them back to the actual note on your system. In addition to loan number, how does that relate to your general ledger? So this is going to be your general ledger chart of accounts. So you could have, 10 different loan categories or 4 different loan categories. Doesn't matter to us, but we'll want a GL code so that you'll be able to aggregate the information by GL code. Loan type, this could be collateral code, call report code, but this is going to be our mapping to the various segments on the call report. Is it a credit card? Is it a mortgage loan? Is it commercial real estate? So loan type. So these are all columns B, C, and D are just identifiers that'll tie us back to the note that'll allow you to do a reporting down the road. Zip code right now, it has no predictive value, but as we're gathering data across the country, and we have all this information by zip code, there's 75 MSAs across the country. About 6 months into this, we're going to take this information and go back and see if there's patterns developing based on those MSAs. Origination date, that's going to be key in telling us the age of the loan, the origination amount. How much did you lend this person originally? That's going to be key. The last payment date. How many days has it been since they made a payment? We're finding out that if folks don't have good FICO scores, risk scores, that the interest rate, the higher the rate, probably the riskier the borrower is. So you've already baked in some risk into the interest rate. So that's definitely going to have a bearing. The collateral value at the time of origination, credit limit, that type of stuff. The scores, like I said, the FICO score, if you don't have that, but you have risk rates of 1 to 5, then use those. And then whether the loan charged off or not during the month. What we do then is we get the data ready for the model. So we've got our run date, the loan, the unique identifier, if you will, the loan number, and then these are the actual scores, the loan to value or credit limit, the FICO score, loan to origination balance, the interest rate versus Fed funds, the spread there, the average age in years for the loan, the last days since the payment was made, and whether the loan was charged. And what we're doing is we load all the data and we break it up into pools. As I mentioned, we're going to have that category code that's going to tell us what part of the call report are we running this for. Is it for real estate? Is it for consumer loans, credit cards, etc.? So we're going to run models for each. And we're going to come up with a statistical score of a note likely to be charged off, and then multiply it by the average age. So once we've done that, we've done it for each of the pools for the entire system. We're going to write the scores back into the table. So you've sent us this information. We load it into the master database, cut it up by loan type, then run it through the model, and then it comes back with a CECL score or a reserve for that specific note. So we load all this data into the data warehouse, and then we give you the ability to report against this. So here's BI 360, and we're loading data into a data warehouse. As I mentioned, you can have unlimited data sources loaded into the BI 360 data warehouse. It can be general ledger data, it can be revenue data, loan performance, financials, budgets, customer information. It's an unlimited variety. So here I've got a loan details report that has the information you sent us, the account information, the general ledger. So I just simply dragged and dropped some of the fields from this loan table that all the CECL data is being loaded into. I'll go ahead and run it. And now I'm doing this by GL code. So I've simply, I may have 20 different banks, 30 different banks. So I'll pick up bank one, and then it'll be the GL codes relevant to that bank. So I just want to see how my commercial loans did, versus my CECL analysis on an actual basis. I'll touch on forecaster in a bit, but an actual basis. I'll go ahead and run it. And essentially what it's doing is looking at those 12-month history. Here's the outstanding portfolio balance. These are the charge-offs for the month in basis points. And here's the recommended CECL reserve for the month. And there's the percentage. And then monthly production. We're looking at new loans put on the book. So out of the $15,349,000 was put on this month with its own unique CECL reserve to those specific notes. Everything is drillable, so I can drill down into this information and see the individual notes of every single pocket. What made it up, what were the various pieces, scores, or what reserve rate did you come up for that note, specific note. So all those details are fully drillable. You can take this information, chart it, graph it, all sorts of good stuff. So here's a chart of the data. We also are doing a little bit of forecasting. My forecast, what I did is I added a few days to the days past due and reran the scores. Had your individual institution, you'll notice the reserve jumped. It was 271,000 at 156 basis points. Now we're saying, oh, wait a minute. Now you're going to need to put up a lot more money, 400,000, so an additional 130,000. Once you have all this information, you can drill into it. You can also download it in CSV, but we'll work on the best way to get it back to you so you can post your journal entries, prepare your audit papers, defending the various reserves. So what we're offering with CECL Clearinghouse is, free of charge, is that if you'll send us that input table, where basically we'll score your loans, give you these reports back. So the cost of the service ranges anywhere from $4,950 to $14,950. Just depends on asset size. All right, well, folks, that's all I had then. I really do appreciate you dialing in. That is CECL Clearinghouse, a new service for banks and credit unions for those that are struggling to come up with good statistical models. Thanks again for tuning in, and hope you have a great rest of the day. Bye-bye.